Hello everyone. Today I wanted to talk about the new tax reform bills that have been passed by the Senate and House of Representatives. Major tax changes are coming and you need to be prepared. I'm going to break down all the major tax changes that will likely affect you. Stay tuned. My name is Noel Lorenzana of Lorenzana Tax and Accounting Services. Office is located in Chicago and Morton Grove, Illinois. I'm an Illinois licensed registered CPA, and I'm also a certified tax resolution specialist. Major tax changes are coming in 2018. Changes this drastic haven't been seen since the Tax Reform Act of 1986. So the Senate and House of Representatives have passed separate versions of the Tax Cuts and Jobs Act promoted by President Trump. This leaves us with two tax reform bills that need to be reconciled before being sent to the President for final approval. Most sources expect the Senate version to mostly prevail over the House version during this process of reconciliation. Here are some notable differences between the two bills. The standard deduction and personal exemption. Okay, the new proposed standard deduction amounts proposed by the House and Senate will basically double for everyone. In 2018, for a single person, the standard deduction is $6,500. Under the new proposal, it's $12,000. The $4,000 personal exemption you normally get would be completely eliminated. They say the exemption will be factored in with the higher standard deduction amount. This change benefits taxpayers without children, but hurts those with children. The home mortgage interest deduction. This is a big concern for many homeowners. The Senate version effectively maintains the deduction as it stands, which is up to $1 million of debt on your first and second homes. The House version limits the deduction of mortgage interest to $500,000 on new mortgages and only on the taxpayer's primary home. If you have a home equity loan, under both plans, these would be eliminated. Next up, taxes. Both the Senate and House version would allow for a maximum of up to $10,000 of real estate taxes paid as a tax deduction on Schedule A itemized deductions. Under both plans, the deduction for state and local income taxes would be eliminated. This is bad news for people in high tax states such as New York, California, and even Illinois. Let's talk about tax rates. The Senate version retains the existing 7 tax brackets while reducing the top tax rate to 38.5% from 39.6%. The House version has 4 tax brackets, 12, 25, 35, and 39.6%, keeping the top tax rate at 39.6%. Repealing the Affordable Care Act individual mandate. Okay, this is the requirement to have health insurance or pay a penalty. The Senate version repeals the Affordable Care Act requirement. The House version has no repeal of the individual mandate, and it lacks support by members of the House, so we'll see what happens with that. This difference may be one of the most difficult to reconcile. Let's talk about other deductions. Under both versions, most other itemized deductions for individuals would be eliminated. This includes deductions for unreimbursed employee business expenses, namely the home office deduction and other 2% itemized deductions. Charitable contribution deductions wouldn't change. Deductions where you don't have to itemize your deductions, also known as above-the-line deductions, would be mostly eliminated, including deductions for student loan interest and moving expenses. Let's talk about the child tax credit. Currently, the credit is $1,000 per qualifying child under age 17. Under both Senate and House bills, the child tax credit increases to $1,600 and $2,000 respectively. For you homeowners wondering about the exclusion of gains from selling your home, while currently for married couples you can exclude up to $500,000 in capital gains from the sale of your home. That is if you lived in the home for at least 2 of the last 5 years. The new proposal under both bills would require living in the home for at least 5 of the last 8 years in order to qualify for the capital gains exclusion. The bills would also limit the use of the exclusion to once every 5 years. So what can you expect next? There's a lot more proposed changes, including changes to corporations, pass-through entities like LLCs and partnerships, the alternative minimum tax, and the federal estate tax. Tax reform and major changes to the tax code are a certainty and will affect all individuals and businesses. Most changes will likely take effect for 2018, but some may affect 2017. For the average taxpayer, your final tax bill may not change much, but how you determine your taxes will change significantly. From my experience, changes to the tax code make things more complicated. This new tax bill isn't any different from ones in the past. The new regulations need to be studied, understood, and implemented, and that takes time. The impact on your taxes will be determined by how the changes impact your specific situation. It's best to ensure you're working with a licensed tax professional to ensure the best possible result. Again, my name is Noel B. Lorenzana, and I would be delighted to work with you on your taxes. I'm an Illinois licensed registered CPA. My offices are virtual offices, meaning with technology I can help you wherever you are. Let me know if you have any questions and contact me at 847-780-6635 or info@lorenzanatax.com for a free consultation. Thanks for watching. Take care.